and driver concepts in doing that, and we then try to restructure our income statement to fit into what we want. So let's get started with the structure of income statement, also known as profit or loss account. Please, if you have any question, you can always type that in the chat box. Income statement, just as the name implies, income, just you giving report of your income. Now, which means before you can have income, there are some things that need to precede that. In income statement, you can only see 2 line items, but let me make it 3 line items. I mean categorization. Is either the line item is an income, more like a revenue, or an expense or cost. Then you have your profitability. So revenue, income, sales, turnover is the same name. Cost, expenses, and profitability. So which means any line item will always come under these 3 in your income statement. Let's start with one. Revenue is like the umbrella of a business. Now, we'll be looking at structure of financial statement as a corporate finance modeling guide. So which means if you have any question, please ask. So revenue is like the umbrella of every business. See, okay. Oye Dikachi said you can't hear anything. The class has started. Maybe you want to log out and log in again, right? Okay. So maybe someone can help us type and respond that maybe person should log in and log out again. So revenue is like the umbrella of the business. And that's why in corporate finance, we invest so many time in forecasting revenue. Not just because it's an umbrella to the business, because we can use every line item as a driver, as a pointer to revenue. Now, for a typical mature firm, publicly listed company, a company can also be mature and not publicly listed, can have access to their historical financials. So it's still the same thing. Revenue is key. Now, there are so many things that drive revenue. It can be very difficult to say, can be very difficult to tell. But now there are some that what drives the revenue is in another line item. And I'll give you a very good example. For a typical bank, if you want to build a model for a bank, you don't start from income statement. You start from balance sheets. It's a very different ballgame. Because what drives the point of building any corporate model is from what drives the business as a whole. So for those type of banks, you definitely start from balance sheets. Just that's the way they are. Right? Also insurance as well. They also fall in that category. But for every other business, 80% you start from revenue. Now, what drives revenue? Revenue is the umbrella. We spend time on this. So the model we'll be building together. See, we are building realistic model. So this one is not it. As I said, this is not a training. Okay. Now, and everyone is eating from revenue because it's just like the umbrella. Everything is under it, and everyone is eating from this guy. And the first person that eats from it are people that are more like a neck to the business. Before you can generate that revenue, you need to incur this cost. They are like the neck. Without you incurring that cost, you really cannot get this top guy. Now, in incurring this guy cost of goods sold, cost of sales, the neck, management efficiency comes into play. right? Now you have your gross profit, which becomes the next umbrella. Just look at the shape, because everything is as a what, so which means we are saying, you know what, revenue is revenue. That's one. The analysis, the outlook and the everything, that one will be a separate story. But now once we have that revenue, the what is left is, let's look at how every other thing move in line with this revenue. So look at this revenue as revenue is 100%. Let's look at the percent of shares each of these are taken from me. So cost of goods sold, that guy has eaten. We have our gross profit, which becomes the next what? The next umbrella. And the next people that eat from this, selling general and admin expenses, operating expenses, also known as fixed cost. They come in to take their own portion, right? And after that, what's the next thing that we have? Then we have our EBIT, earnings before interest and tax, also known as operating profits. Okay? And after that, the net finance cost guy comes in. Then we have our earnings before tax, same thing as profit before tax. Then we have our tax, and we have our earnings after tax. So which means if you look at this proportionally, right, here our earnings after tax to our revenue, you can see the percent of what is left. And this is what ratios, margins that you do. This is what it is saying. So just look at this as ratio margin analysis. So now you now know what we do, which we are going to see. We take a company, historical financials, and we put them in this particular shape. Everything as a percent of that revenue. We are saying let's leave revenue the way it is as 100%. Let's look at the portion of everything. And you know what we now do? We will now play it over time. Remember the our historical financials that we have, right? If we want to go deep into analysis of this, that's more like the first thing that we need to do. But I know because though I would have asked us to go ahead and do that similar thing, right? Activity, do it as a group, then come to the live session. I will do a lovely presentation. I think should we do that? Should we do that? Okay, I will think about that later. So which means we play this over time and see if this shape is constant, if this shape is not moving anyhow over the last historical years. Now, for companies, right, that kind of maintain almost the same structure, it makes our work easier as a corporate finance modeling guy to do what? To make a proper forecast. We believe that those kind of companies are less riskier because we can actually, the shape seems to be within range over the past 5 years. So we definitely, that's because it's a mature company and you expect them to be able to what? Maintain that. That's management. And that's where building of corporate model comes with ease. But whereas you plug this, you look at the company year 1, year 2 is given different, year 3 is given different, year 4 is given different, then you know that you are in a big a big soup, right? You definitely know you're going to need extra work to do. So after EAT, the pay dividend, you have your retained earnings. From revenue down to gross profit, we call it top line. So when we are saying, oh, gross profit margin as a percent to revenue, basically we are saying, how well are they managing those variable costs over time? And this is ratio analysis, which you always say. So by the time they say, oh, what's your gross profit margin? Basically, portion of revenue that made up of this. What is your net profit margin? Portion of the revenue that goes straight into this. Now, revenue to gross profit at times can be very difficult to manage by management because they are unavoidable. But from SG&A down to earnings after tax, they are more, they call them bottom line, which can be influenced by management decision. So which means anytime anything happens to the top line guys, right? Definitely the bottom line guys will definitely suffer. And you know the one that suffer the most, SG and A. Because the company needs to maintain this portion, they need to maintain this ratio margin. Now, let's look at it from another angle, which we call analyst structure. Now, this is more like a typical accountant structure based on standard. And this also tries to achieve that it's easy for us to company the same across board based on standard. But when it comes to corporate finance modeling, we build typical corporate models for one insight, but which is one of the most important thing, insight. Secondly, for risk management. And in making those decisions, we need some specific line item that will help us to answer the question clearly the way we want it. And thirdly, valuation. Valuation is a very pure concept that tend to say, if you are saying this is revenue, revenue should be revenue. If you are saying this is cost of sales should be truly cost of sales. But in a typical reporting standard, it does not play out like that. Because if you look at it closely, cost of sales as reported might truly not, everything in it might not be a cost of sales. And one good example is depreciation on property, plant, and equipment. Let's take it a step at a time. So as such, we analysts, we prefer to have it in a specific structure. So now we have the revenue umbrella. Everyone eats from this revenue. The first guy that eats as a neck, cost of sales, we have our gross profit, which we said top line item. Clear. Okay. We have our operating expenses, and then we have our EBITDA. EBITDA comes into play. Now, let's look at it from a typical management accounting. Revenue, the cost of sales becomes variable cost. Gross profit becomes contribution, right? SG&A becomes what? Becomes fixed cost. And then we have our EBITDA, which we call profit, which we call pure profit. Pure profit in terms of cash, because this is basically every business operation, core business operation. We call it core business operation. And you know what this structure helps us to do? It helps us to compare company A to company B to company C across same industry. Now, so don't do, let's leave the volume of your revenue. Let's put that aside. Yeah, revenue, irrespective of the kind of your own capacity. Let's leave it like that. Then we are now measuring every other line item as to that percent of revenue. And that's where the comparison comes into play. After that, we include our depreciation, amortization, which deals with the use of assets. And then we have our operating profits. Then the next question is, why are they conflicting each other? The standard is saying the standard does not show depreciation. The standard just moved from operating expenses straight to operating profits. But analysts are saying, you know what? Let's look at the pure core business operation. Let's have different segmentation clearly stated because of insight. So depreciation and amortization, most times accountant, what we usually do it, we put depreciation and amortization, we put some in cost of sales and we put some in SG&A. For example, if it's in manufacturing, your depreciation on those property, plant, and equipment your factory equipment would be put under cost of sales. The one related to office furnitures and things will be included in our SG&A. So analyst structure are saying, you know what? No, let's have the pure cash expenses like this, such that if you are saying cost of sale is a percent of revenue, to certain degree, we are sure that everything we are saying that we have inside cost of sales can be driven by revenue. Everything inside operating expenses can be driven such that if anything happens to revenue, it will affect them. But for a typical depreciation, is the other way around, because you've already incurred the expenses a while ago and you are just spreading it across. So it does not mean that if revenue drop by 20%, depreciation is expected to drop by 20%. No, does not work like that. But if revenue drop by 20%, you expect the same movement in cost of sales. You expect the same movement in the operating expenses, because companies, they don't need to incur unnecessary expenses. But depreciation and amortization, definitely you don't expect such movement in it. So as such, analysts are saying, what, let's leave those two guys. So we go to cost of sales, we bring them out. We go to SG&A, we bring them out and leave them separately. Now, they are still part of operations of the business, right? But because they've been accounted for initially and we are just spreading the cost, that's why we bring that below EBITDA. Now, we have other income, finance costs. This deals with business financing and investments. These are all business, how much this business can get when it comes to capital structure and how they generates revenue from other activities. We have tax expense, which goes straight to the government, and you have your profit after tax. Now, from SG&A to profit after tax, net profit, we call them bottom line, and everything are more of management decision. And a good example is company A, and that's one of the reasons why we analysts prefer to back out depreciation in cost of sales and SG&A. Because let's look at it. For comparison's sake, company A is making his own production in-house. So which means definitely you expect them to have more property, plant, and equipment, especially factory equipment. But company B is outsourcing, right? So company A is making his own in-house production. Company B is outsourcing his own production. Now, tell me, who do you think we have more depreciation in their balance, in their financial statements? Let's discuss that. So company A making his own in-house production, right? They have all the property, plant, factory equipment. While company B, they are outsourcing their own production, right? So which means they might definitely have less equipment. Then who will have more depreciation, right? Then company A. Now, this does not mean they are not in the same business. They are doing the same business. In fact, they are almost the same. They are almost the same size. But because of management decision, so we want to see, hey, let's leave those kind of thing out first. Let's focus on the core thing, and that's why you can value a business using EBITDA multiple. So they remove every other noise from it. You want to do your discounted cash flow valuation, you remove all the noise till you get your operating profits. So these are management decision. All right. Now, with the understanding of this income statement, let's do one small activity. I say, learning, practical. You get to do it. I'm just providing guidance. So with your understanding of these financial statements, we've created one activity for us just to refresh our memory and to check our understanding of financial statements. So I'm going to drop a link in the chat box now. We'll drop the link in the chat box for us. right, so we have the link in the chat box. So please click on it. By the time you click on it, it should take you down here. So before we go back into our model, let's test our income statement knowledge, understanding, right? Before we continue with our model build. So by the time you click on the link, it should open up this document for you. So you can download both of them. This is my own version of the Walmart corporate model. Why this is the income statement activity that I want to do. So download it. So right click and download it, save it on your desktop. So download it, save it on your desktop, come back to my screen and type done so that I'm sure we are all on the same page. Right, so let's wait for others. So download it, save it on your computer. Right, so we are waiting for others. Please type down in the chat box so that I'm sure we are on the same page. All right, so now I'm going to give you the password. Yes, the file is passworded. Don't worry, this is an activity we'll be starting the same time. We are doing it together. So more like you warming your fingers, right, before we go into the main, before we resume back to our model. So let me open the Excel file and run us through what we need to do. So I'm going to give us the password. We'll be starting the same time. All right, so you've been provided with this work file, and what you need to do is build a forecasted profit or loss account. Here you have your inputs, right? Input for each of the line item: revenue, year-on-year growth, cost of sales, percent of revenue, operating expenses, percent of revenue, depreciation, absolute value, interest rate, and also the outstanding loan balance. And you've been provided with your provision for tax expense. Now all you need to do is to fill these ash colored cells, right? You have a guy that will be smiling at you if you get it correctly. For example, to forecast my revenue, that will be previous period multiplied by, open a bracket, 1 plus, go to my input, that will be my revenue, right? Close the bracket and enter, and I can drag that. So the guy will be, if you've not completed it, the guy will be frowning at you, telling you to keep trying. So if I drag this across, the guy will smile at me and also show the expected formula. So you go ahead, fill all these hash colored cells. Once you are done, calculate your margins for each of these, right? And by the time you are done, currently this guy is showing well done, keep working. By the time you are done, the guy will change to completed. Write down this code. So it is the code that appear here that you type in the chat box, which will be like a confirmation that you are done. So if the guy is showing you keep trying, right, then definitely you should know that. So definitely you should know that I'm using my phone. Okay, I don't expect anybody to even say that in this our session. Right. Okay. So I'm going to give us the password now, just for you to warm up your fingers. There you also have like a or what should I call this? More like an expo, right? Just for you to see formula you need to put in there as well. So I'm going to give out the password, and this should not take us more than 5 minutes. Yep, 5 minutes is even too much. So the password is milk MILK. Right. So I believe this should be a simple thing if you are in this session. This should just be like a warm-up thing and a reminder on how to create your income statement. Okay, so the password is milk. I will be quiet now so that you'll be able to concentrate. Once you are done, as I said, to change this guy showing well done, keep working, we change to a code. So write down the code, which will be like a confirmation that you are done. Well done, everyone. So let me see. The minutes we have left. No, you don't have to type done. A code will appear when you are done, right? It is the code that you should write in the chat box. So by the time you are done, a code will, instead of showing well done, keep working, we see done, write down this code. That's what will appear on your Excel file. So please, we have 2 more minutes to go. I'm not sure why people that are asking that I should recap the instruction when we're almost done with the activity. That's funny. It seems we are not together on the same page. All right, everyone. Thank you. Thank you. Thank you. Thank you. And this is the end of our activity. So please, if you are struggling to complete this income statement, please, you might want to consider going back to level one. And I'm being serious here. If you are struggling to complete this type of task, then I'm questioning your knowledge of the level one that you said you have. Right? I said, don't jump level. You don't have to. There's no way you can be a sound corporate finance modeler without having that basic. Right? If not, things like this will always hunt you down when you need them the most. Okay, so I'm going to close this. We are not doing this in the class, so I believe this should be like a basic thing. It's just like a warm up for us. Okay, now let's go straight into our model build. Let's go straight into our model build Okay, let's go back to our model build. So thank you, everyone. Thank you for that. Thank you for that. Thank you for that. There should be no question. That's just a simple income statement. So if you struggle with it, maybe after the session you want to sit down with it and redo that. Okay. So as part of our task in the previous session was for us to go ahead and extract the historical financials, which we've done. Right? And as I said, please let's stick to instruction this stage. If I'm saying use color blue, use this color. Please try and use it. If I'm saying structure it this way, try and structure it like that. The best way to learn is first copy. Do it the way it's being done. I created a structure, provided a video. Some people still went ahead and they did another thing. But some people did not even follow our own format. And please, if that continues to the next level, we might just observe that we start dropping some people. Okay, at this stage, that's so. For example, if you want to learn how to draw, right? They definitely going to give everyone, hey, this is a copy of what you want to draw, and that's what you're expected to draw. So please, let's do it like that. Have open mind, right? Follow this. Then once you are good with this, as I said, you can start creating your own version by the side. Do it the way you want. Right? As I said, this is not training. If it's a training, I can tell you that, you know what, go with what you want the way. No, this is a mentorship. This is like creating a copy. Right? Do it the way we are doing it now. You can create your own version. I'm saying it because against the next session, I might not allow what happened this period. And that's why I took my time to create a historical version, send it to you guys, even with a video guidance. All right? Okay. Now, the first thing we've done is doing this historical extraction. And before we even start doing anything, we need to first take our time historically to analyze and understand what has been happening in the business. Right? We need to create that insight. Now, for our own insight that we want to create, we need to put the financial statement in a structure that we want. Okay? So now, first thing we need to do is let's go back to our control worksheet. Let's go back to our control worksheet. And I think the last thing we had there was this model navigation, right? So I'm going to leave like two rows, right? And I'm going to call this financial statement structure. So please, it's always good you do it like this. So financial statement structure, and the first one is income statement structure. All right? Income statement structure. So let's first lay out our own structure. So the first one that I'll be starting with, I'm sure you should be able to create typical income structure on your own. So one is revenue. Then let's make it, let's be professional a little bit. So this will be cost of sales, cost of sales. So you can see that negative sign that I put in front of it. Then gross profit. Okay. So gross profit, you can even index this a little bit. Then here, can have my, let's have our SG&A. I think what they call it in their operating. Okay, yeah, so SG&A. So less to SG and A. Then we have our EBITDA. Okay. So let me look at their balance sheet. Do they have separate PPE? Okay, they don't. There's no intangible asset. Let me go to the cash flow. Okay, so I think it's just straight depreciation and amortization. So depreciation. So also put that in the brackets. Then we have our operating profit. Can even be, should we do, okay, yeah, so maybe let's make it look good. So we can just put, do we need to do, no, okay, let's put it together. So operating profit, let's look at the historical financials. Then we have all these interest, blah blah blah. So let me just copy this and put it here. Okay, so interest on debts. So let's start interest on. Do we even need to do all this? I think it's better for us. So what we do is let's just call this interest expense. So interest expense. Then we have interest income. So this is addition. Then loss on extinguishment of debt. Not sure what that is. Okay, not sure we will need that, but at least let's leave that. Okay, let's put it as that will form part of our interest expense. And these other gains, so they could be our addition. Okay, so let's look. Make sure we're fine. Okay, good. We have our profits before tax. Then we have our tax expense. What do they call it in their own? Okay, income tax. Okay, so maybe tax expenses. That's fine. Then we have our net profits. Okay, so let's go ahead. What about the cost margin that have no previous value for 20? A step at a time. Please take it slow. Take it slow. Take it slow. Let's create our financial statement structure. A step at a time. A step at a time. A step at a time. But what's that question? What about for the cost margin? They have no previous value. Cost margin. Cost margin. So please always in 2024. Which 2024? So in corporate finance, right? It's always good you be careful with the terms that you make, right? So when you say cost margins, so that's expected to be like 8%. Okay, so we need down up to net income. Okay, so maybe let's use these two guys. Let's use these two guys as well below, which would be okay. So then we have our net income attributable to these other guys. Very good. All right. So please, if you are done, please just type done in the chat box so that I'm sure we're on the same page. Just creating this structure. Should be quite straightforward. Let me see. Can I paste it? Can I copy and paste it in the chat box for you guys? I think I can do, but can I copy it and paste it in Excel? They still maintain the same structure. Okay, I think I can do that. Oh, okay. But I think you can also copy and paste it, so that it might wrap it. So let me copy it again. So in case you don't want to type, just come to the chat box. It's always good. It's just go through the process. Luafemi, you can't hear or see anything. I mean, that's a strong one. That's a very, very strong one. All right. So I think should we create? Okay, let's do for income statement first. Or should we just do it once and for all? So let's also do for the balance sheet. So let's do for the balance sheet. Let's do for balance. So we still need to do the same thing for balance sheet and cash. But let's do it one after a time, one after the other. Okay. So one after the other, one after the other. So here now. So what I want you to do is highlight from revenue. So what I want to do now is highlight everything from revenue down to, in fact, you know what? Let's add like additional space here. I think we created something like a blank, intentional black cell style. Okay, yes. So copy this intentional black cell style and put it here. And put it here. So let's copy this. Then highlight everything from the revenue, including that blank cell, so that by the time we want to insert any line item, so we might want to insert some line item, right? It's easy for us to just insert it. So highlight everything from revenue, including the blank additional cell, additional row, right below it, and go to your name box. Sure, you know name box now, and just type financial statement. Okay, just type. I'm looking at the best name to use. So P and L. So P N L underscore capital list, LIST. So P and L list. So highlight from revenue, including the empty row that we included, and then go to your name box and type P and L, P cap, N normal lower cap, L cap, then underscore, then L for list should be in capital letter and others, IST lower cap, then press enter. Press enter. Press enter. Do you have that? Do you have that? Do we have that? Okay. Now, so typically, we can see that their financial statements, what they've done is they've put them in absolute. Now, I think financial modeling standard is also saying if you are building a model, you should try to put everything in positive. For example, you can see this cost of sales. You can see that is in positive, right? Whereas they are deducting it. But as I said, most times in a typical corporate space, right, they always use a negative. So I'm not sure why financial modeling standard is saying you should go with everything should be in positive. Then what is really applicable in typical corporate world, they prefer to have it in negative, right? It's just easy to read. So what we are going to do is let's come to our financial statements, historical financials, right? We are still here. So what I'm going to do is I'll just copy my header 1 and header 2. Header 1 and header 2. So maybe just come to row 140 and I'll call this my restructuring. So just call this restructuring financial statements. The first one will then be our income statements. So income statements. So how many of us know, if you know how to use group outline in Excel, I think that would be a good thing for you to use. If you know how to use, group outline. So let's just group everything. I can highlight below my extracted historical income statement before the second header, right? Then Control Alt right arrow, and just group that. The second one for my balance sheet to do the same thing, and for my income statement, my cash flow also do the same thing. So that I can just collapse my balance sheet. Collapse my balance sheet. So let me adjust my group outline. So I just put that to the top. Okay, good. So we need income statement, so I can just collapse my balance sheet so that I have only my cash flow, my profit P&L, right? Only my income statements. So create a group outline so that everything is just collapsed like this. I'm sure we know how to do that. Yeah, no one should be in this session without not knowing how to do group outline. Please, if you are here, just report yourself. Okay, all right. So now let's create our see my spelling. So this should be restructuring or restructured financial statements. Restructured financial statements. Not sure what's happening to my spelling ability. Okay, so restructured financial statements, right? So let's take it one after the other. All right. Now we've created this guy with that name range. So what we do is let's use okay, please you can go online. This is nothing special about just how to create a group outline in Excel. You can just note it down, then you can do that later. Just help you to collapse certain thing. But maybe we should just do it together. What do you guys think? Yeah, so let me repeat it. Let me clear my group outline first. Okay, so now whenever you have a set of data like this, what most people usually do is they then tends to create it in different worksheets, then just having multiple worksheets. And that's why you now have group outline. And what group outline we are supposed to do is to kind of collapse it. It's not hiding it. So there's a difference between hide. There's a difference between when you want to hide worksheets and when you are grouping it. Right. So don't hide, just use grouping outline. So to do that, one is you always have where you want the grouping to start from. So here, whenever I group it, I want this header to always show. I'm not sure people that are joining and are in the lobby. Is it that you did not register or what? Or you guys are joining illegally? Because you are diverting our attention, right? So whenever I kind of collapse this, I want this header to always show. So which means I need to highlight from below it, that row, highlight from it, then drag it down to maybe where I want the second header. If you want to have a space, you can leave the space, but there's no need to have that unnecessary space. So before the next header, right? So you see that I'm highlighting it. Then I'll now I'll go to my data tab, and if I look to my right, I'm facing my screen, so which is my right. So yours might be, depends on the size of your screen and the front of your laptop. So it might be grouped, but you will see this guy called outline. And under this outline, maybe you might need to click on the group down option. Then you will see this guy called group. Right. So if you click this group, you even just click it like this. You click on the group, it's going to ask you, do you want to group rows or columns? Because we are grouping rows, so just click on your rows and click on OK. Then the guy will appear. I think at times it might show the other way around, where let me put it back to default. So by the time you do that, you just see that it will show like this. So if you click, so you see that up here, number will appear 1 and 2, basically telling you that you've created a group outline. So if you click on 1, it's just collapse that. Now you can see the plus sign is moving down below the section. So I don't know why Excel do that by default. So to change that so that the plus sign is showing on this particular start on this row 11, you come to that same section back where you have the group on group subtotal. You see this drop down, this guy pointing down, this guy, right? So you click on it and it will open up this setting tab for you. So you can just untick summary row below data, then summary column to right of the detail, and just click on OK. So by the time you collapse it back, you just the plus sign just appear on it, right? So I think the first one I did was using the shortcut. So that's by the way. Okay, so now next thing for us is we want to recreate our restructured financial statements, right? So what we are going to do is, because it's always good you keep the same structure, we are going to build this in a very dynamic way. Okay? So should we use data validation or we should use referencing? So most time, well, okay, you know what? Let's so type equal to, let's link this straight to our revenue. Let's link this straight to our revenue. Okay? I think we created our model currency, right? Created our model currency to revenue. Okay. So in case the line you see from column H to column M, if you think that space is too much, maybe because of your own screen, right? You can also group it as well. So you can group from column H. So I like from column H to column M. And if you go back to your data, under the group outline, you can click group, and this time just click on columns. Then so that the space are not too much, but we definitely need all these particular rows. So that's why we just have to leave them. We need it in our calculation, so you can just group it as well so that it's looking nicer. Right. Then here, go ahead and link this to the total revenue. Link it to the total revenue. Link it to the total revenue. I think that's more of what we need. Then we need our cost of sales. So cost of sales here. So now because we are using our own other convention of negative, so equal to, so put minus, would that be a good practice? So come here, right, under this input and put -1. I think this is better. Yeah. So put -1 here. Should we do it there? Okay, you know what? Let's do it here. So let's do it here. So anything negative, -1, -1, depreciation, -1, interest expense, interest income +1. Right, I think just put, so let's put this let's put this sign. Let's put like a sign number here. So those ones that we are deducting, we just put it the way, put -1 in front of them. So put -1 in front of them, just which means they've put it in positive with their own value, but because of our own structure, we want to have it as a negative. Then I can link this to what we have here. So it's always good to link everything to one source. And I can just do my cost of sales. So my cost of sales here, right? Then you can multiply by the -1 that you have here, so that it just turn that into negative. We can calculate our gross profit. We can calculate our gross profit. Calculate your gross profit like this. Okay, so it's not, as I said, it's not a good practice where you are typing anything in your formula. Right, so that's why it's always good. You just create those sign as a negative here. If you want to put it in input, you can decide to make it input on this our list. You can also create our list, put it in input sales type, so that they know that these are all imputed value. Right. And this is the same structure that will flow in. So a good thing about this is if they want to change maybe the description or anything in the line item, and maybe you've created that same line item different line, you've used it in different line in your model build, it's easy for them to just, it's easy for you to come back here, change it here, and the changes just apply across in your model. So that's why this approach is always good. Okay, so gross profit, then below, let's have our, so equal to, we need our SG&A. We call it SG&A, operating profit, operating expense, but anyways. And below it, so also everything should link here. Even gross profit, link that here. My EBITDA, everything should be coming from there. So you go ahead, you do the same thing. Oh my, those corporate model can be so tasking. I won't lie to you, but still one of the skill you can have. So I need also my units. So this currency, the sign. I'll go ahead, multiply my HGN here, up here, right? Multiply by the negative one so that we have it in negative. Don't put equal to minus here. No. Go ahead and do that negative somewhere. Then EBITDA, gross profits. So we have the EBITDA, right? Okay. So let me leave you to do the rest. So below here, I think we can have our depreciation. Depreciation, so equal to, just link that. Depreciation and amortization. Please, if you have any question, ask. And I believe we are doing this together. To link this to the sign. So we'll come back to the depreciation. Just link that depreciation for now. Sum your, calculate your operating profits. Just calculate your operating profits. So leave depreciation now. Just leave it the way it is. Then the other ones that we need, interest, expense, are those ones. We have a profit before tax. So link that to the sign. This man is just doing the activity. Interesting. To sum. So the one for interest expense equal to, so I can sum everything for the interest expense. So we're saying interest on debt, interest on finance expense, and interest on loss on extinguishment of debt. Sum those together, right? Then remember to multiply by the sign. Multiply by the sign. Sorry, Luafemi, there's really nothing we can do regarding your network. It's beyond our power, you know. Then the interest income. So now let's come here. The interest income, they said that as negative here. So which means we might need to multiply that by negative. So we might need to multiply that by negative to give us a positive. So just put -1 in here as well. I think all the line items should even be multiplied by that, by the sign. So in case anything wants to change. So please let's put sign. So revenue, that one should just put 1. Leave gross profits, interest income. So just leave those ones with 1. So please, as I'm doing my own, be doing your own as well. That's the best way to learn. So interest income, negative in their own. So we need to multiply that by negative so that it gives us plus. So the loss on gain, I think that also we need to multiply by negative as well. That's addition. So equal to that gain. Then multiply by that our sign. Then we need our tax expense. do the same thing for my tax expense. So like this. Then we need this other two, net income attributable. Then I think that also should have its own sign. So I think the net income attributable is in absolute value like that, but let's still put one here. When you build this kind of model, we call this kind of model optimized model. This kind of model that are very easy to optimize. All right, so we now need to do like a check. So net profits check. So let's do our net profit check. As I said, so everything we've done, we just need to make sure that my net profits minus my net profit of my restructure, is it the same thing with my net profits of my audited extracted financial statements? So just like that. So check are always good. I think you can even use if this minus this is equal to 0, then just give us okay. Give us okay. If not, should give us the difference. All right. It's okay, fine. Oh, you know what? Let's just do the minus. I remove this if thing. So that by the time we are creating our overall check, it's easy to do that. Okay. And under the total, just sum everything here. Should give us 0. So which means by the time you are done, recreating yours like this, everything should be the same. Everything should be the same. We are not changing client data, right? We are not changing our client data. Remember that. We believe the audited financial statement is correct, but all we need to do is what? We need to put it in our own analyst preferred structure. Okay, so please, any question? Where we are? Hope I'm not too fast. Even if I'm fast, it's part of you also need to be as fast as this. So you collapse your group outline, you just kind of look good and you don't need to see all your magic workings. Yes, it's also part of the learning. You also need to be very, very fast. Yeah, it's part of it. Can imagine building for because when you're especially in corporate finance guys, especially those investments guys, you have like you need to model for almost 5 different entity. You have a limited time to also do it, so you need to be very, very fast. So, please, you added loss on extinguishment of debt to interest expense. Is it not going to affect our model in the future? As I said, any line item in their historical financials, we must include it. We are not adjusting the historical financials, so definitely it should be part of it. So even though we know that because by the time we want to start, we are using 2023 financial statement as our basis. So it's obvious they don't have it, but definitely we need to add it in historical so that we get the same value they've gotten. We are not messing with their data. Please, will the recording be available? There's no need for any recording. If not, we are both doing everything together here. So I'm sorry about that. I'm not sure. Okay, it should be a part of another line item. Yes, it's part of interest, as you can see, on debt. So assuming they have it into the future as at 2023, then we might need to go to their financial statement and check what was that line item. What's it saying? But since I think it only came in once in the last historical period, I'm not sure. So we don't need to waste our time checking which line item should we add it to or should we not. As long as it has this debt name, let's keep it as part of the interest expense. Yeah. So assuming they have it in 2023, then we might be we then need to go ahead and ask, what's that line item? Do we need to add it or do we need not to add it? All right, so I'm waiting for others. Immediately you are done, please type down in the chat box so that I'm sure we're on the same page before we go to the next restructuring thing that we need to do. Okay. There's no need for, I'm not sure why you need record. If your line item are not corresponding, take your time to review it. We've not done anything different, right? This is as long as my historical financials is the same thing with your own, right? I'm not sure why you need this. I'm sorry, the recording. We've not done anything necessarily requiring recording. All right, so please, do we have the restructured? Do we have the restructured income statement? You can see some people typing done, 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 done. Okay. Now, the next thing that we now need to do is to, we can see now that currently now our depreciation and amortization, they are blank. All right. And as we discussed, typically in accounting, what they usually do is, because if you look at these historical financials, right, based on standard, there's nothing like depreciation and amortization there, right? And it's part of our typical practice, at least for financial reporting sake, that depreciation related to cost of sales are always included in cost of sales. That is factory equipment, equipment used in the factory's store. Depreciation on it are always being added to cost of sales. Why the assets used under business operation are added to our SG and A. So which means as part of our next thing that we need to do, we need to go into the audited financial statements, right? And now look at the depreciation they've added to cost of sales and the one they've added to our SG and A so that we can back it out and have the clean cost of sales. Now, I'm going to do one example for you, and I will leave the rest as part of your assignment against the next session. So it's part of the learning, right? Let me see. I think I have like the audited financial statements. I'll do the one for, I think, 2022-23. Let me see. Okay, so 23-24. Let me see this. This is the correct one. Okay, all right, good. So I will do one for us and I will leave you to do the rest. Okay? This is the audited financial. Let me go to the front page so that you're sure we are using this. So annual report 2024, Walmart, right? This is their name, not using any other. So let me scroll down to where we have the financial statements. Go to where we have the financial statements. Okay, so this is our income statement. Okay, so 15,511. Let me also check that. So as I said, our self-review is always good. We are building. So 15,511. Yes, that's the same thing with what we have in the audited financials. So we need our cost of sales. Now, the way they kind of do their own financial statement is quite different from the way we have in other countries, right? I think some are using GAAP, some are using standard IFRS, right? GAAP. Now, those ones you then get to see like they'll give you like the notes to the account, but here you might not get to see the note, so which means you need to take a step further and find where we have that. Let's go straight to the, let me find the note to the account. Let's see our components of cost of sales. I'm sure, please, if you have the financial statement open over there, please let us point us to the page. So let's look for the breakdown. Where is that? I think I should have passed that. So breakdown of both revenue and cost of sales. So please, we are both doing it together. Don't leave me alone. I'm not the only one doing it. So firstly, let's okay, we already have the depreciation in this. Okay, so that's let's just look for the note to the breakdown of the revenue. All right, breakdown of the revenue and the cost of sales. If it's those one that has notes to the account, is always easy. You just know go to you know where to go to, but this is what we have. Yeah, Nigeria company would be better, but sorry guys, not everyone here is from Nigeria, so we need to use like the financials everyone can relate with, right? Understand the figures. Just part of your work, even if you're in Nigeria, you can be required to build this kind of model. Yeah, I think Nigeria and UK seems to give us something else, right? Okay, yeah, we can use. Yeah, please just do your own search as well. We are both doing this together. So I'm not on the table. I'm not sure I'm alone here. So please try and help us. So help us check. As I said, if it's at least, I think those ones that are using is it Gap? I think these guys are using 10K also. Okay, so I was hoping we'll be able to see that, but it seems we do not have access to that information, right? Which now make it very, very interesting for you that you are building a model. Okay, so firstly, let's look at something. So now, one thing about dealing with corporate model is if you cannot see the information, you know what? Don't don't disturb yourself. Don't disturb yourself. Just look for a way and move on. Now, if you look at their typical business operation, so it's a people-led, technology-powered, omni-channel retailer dedicated to helping people around the world save money and live better life, right? By providing opportunity to shop in different retail stores and through e-commerce. So now, which means one, we've established that this is not a manufacturing business. Okay, so as such, definitely they are more of a service-based business, retailer. As such, we do not, so let's make that assumption. We do not expect them to charge any depreciation into cost of sales, right? Since, so remember, because we did not see that breakdown, you don't need to waste your time trying to find what you cannot find in their financial statements. They said if it's for other typical company, they will give you the breakdown and you see the amount of depreciation that has been added to SG&A and cost of sales. In case where it's very difficult for you to ascertain that, you know what you would do, and you look at the typical operation of the business, this is what we are going to do. So under my SG&A, right? Let's go back to our control. And below here, what we're going to do is we're going to add back that depreciation. So it's more like we are deducting it, right? So depreciation and amortization. Let me just copy this guy. So below SG&A now, but this time it will be, so because we are putting it the other way around. Okay. So you can see the depreciation. So the depreciation, let's bring it below our SG&A, but maybe we can even call this guy SG&A before before deducting. So before deducting depreciation and amortization, we can shorten that. Okay, so we have it like this. Let me see. Yeah, at least let's use this for the restructured one. And below here we can now have our the true. So we just call this SG&A. So so SG&A after deducting depreciation and amortization. We just have it like that. Right? Should we, or maybe we should, or maybe we should just use excluding. I think maybe that will serve. So excluding, and then here, SG&A. So instead of, let's just use including, so that's not just white unnecessarily. Okay. So what we are doing is, so depreciation here, we remove it. We are backing it out from SG&A, and we put it in the correct line where it ought to, where we want it to be based on our structure. So we are not adding it twice. So look at it. So I'm saying I've added, so let's say my depreciation here is minus 500. Okay, minus 500. So which has already been part of this SG&A. So what I want to now do is I'll come in here and I will deduct. So if I deduct this 500, right? So because it's a negative invert sign. So what will happen is my SG&A here will now be summation of this guy, which will give me 0. But remember, this is an expense line item. Then I will now come here and put the 500 here, which means I net it off from here. So you know what the effect will be? This my EBITDA will go up by 500. So my EBITDA will go up by 500. Okay, right? And I will deduct it again, which will still give us the same operating profit. So we are not adjusting their financial statements. We are only restructuring it, normalizing it so that we can compare likes for likes, which is the financial statement structure that we were explaining then. So all we have to do is come here, right? Equal to, just link that to my depreciation that I'm adding back and what I have after that. Okay, so depreciation and amortization, SG&A excluding don't need to put deducting again. So excluding depreciation and amortization. Okay. All right. So what I'm going to do is I'll come in here, equal to, we have this in our cash flow statement. So that's one of the reason why you always need to extract both your cash statements when you are building your model. So we have the depreciation in here. So just come here, equal to the depreciation that we have. We have this, and then my new SG&A excluding depreciation will now become this particular value. So here you can just, maybe you can put this guy in a typical brackets, at least so that it's kind of explained. And I can go ahead, edit. So edit your EBITDA. So equal to sum will now be gross profit plus what? The SG&A excluding depreciation and amortization. So what happens is our EBITDA value will go up. Our EBITDA value will go up, and then I can bring my depreciation here, which will be in negative, right? So let me come back here. So this depreciation, okay, yes. So we have the sign already. So which now be equal to my depreciation in my cash flow statement multiplied by the negative sign. So that is a negative. So even before you do that, if you scroll down here, you will see that your net profit check is already showing that depreciation, right? So we are not changing auditors figures. We are just restructuring, we are normalizing it so that it goes with the structure that we want. Okay, so this multiply by the sign, and then if you go back, you will see that our net profit is still the same thing with what we had initially. Okay, so assuming they have depreciation that's been categorized into SG&A and cost of sales, the same thing we did here is the same thing we also do here again. Maybe so that we more like create a difference, we can make this more like italic, right? So that it kind of show what we've done. All right, so which means with this now we are saying if we are building for different 5 entities, we are also going to do this same adjustments. Okay, so now after this, the next thing we now need to do is to do our ratios. So more like I'm going to call this a key performance indicator, which will now be your own assignment. I think we've already done the depreciation together, right? So your own assignment is, let's create insights, basically using ratios, right? So maybe revenue growth. You have revenue growth, cost of sales margin, right? Cost of sales margin, gross profit margin, then our SG&A to revenue margin. Okay, then we have our EBITDA margin. So just we trying to see the shape of the business, especially from cost of sales downward over the past 5 years. Okay, so EBITDA margin. So you can even do depreciation to revenue. As I said, you can use everything as a percent of revenue. Then you have your operating profit margin. Okay, and then maybe you have our profit before tax margin. You have your net profit margin, and any other thing you can think of, right? Just go ahead, include it, do the calculation, and share your work file with us against next session. So next week, I'm not sure we'll be having a session next week. So I think that should give you a time to also review, go through what we've done. But I'll keep us updated and send email to everyone regarding that. So now your own task, remember, right? Create different key performance indicator analysis. Let's look at what this kind of, you guys should stop begging. Why are you guys begging? Please, sir. You don't, please, can you guys stop that? Why will you be begging for us? No, as if you committed any offense. All right, so please go ahead, create your own restructured financial statements, right? Do your margin. Let's look at, create a story, also create a story. You look at what has been happening. For example, if I look at my cost of profit margin, so my cost of sales to my revenue, right? It's easy, I can tell now without even before converting to percent. It's easy to see that yes, we expect to see like a consistent trend. So if I put this in percent, what does this look like? Okay, let me change that percent. That percent is not looking, it's not looking the way I want. Did we create? We created any percent? Okay, I don't think so. So let me just. Okay, so it's easy for us to look at the trend of the business, right? Over the last 5 years. Over the last 5 years. So here, maybe I can even decide to create something like an average, right? So this is just what you need to do, which is your first starting point, right? For you to look at what is happening in the business. Is there like a is there consistency? So which means over the period, irrespective of their revenue, right? They seems to maintain this same cost of sales margin. And you can even try to go ahead and do maybe like a mean of the historical average, mean of the historical maximum historical, so to be able to get that range, right? What is the medium? What is the average? And you expect them to just be within the same range. So since they've been within the range of 74.9 to 75.9, which is one of the best closest, which is one of the close range you can see, right? And that kind of gives you more like a proper predictive input, predictive assumptions, because you can see that consistency. So if you go to the gross profit, and you also do the same thing, you expect that to also follow the same trend, because cost of sales is more like the more driver. So you can see they've always maintained an average of gross profits of 24.6. Now, if you look at the average and we look at the variation, right, over the period, please, is the red color not reflecting negative? Yes, it is an expense now. So this gross profit, attention to details. This is cost of sales margin, not gross profit margin. Your cost of sales is an expense, so you expect it to be profits because our cost of sales is negative, right? So you can see this is what they tend to maintain. And if you look at the variation between the average of the past 5 years to each year, 26.4 in 20 uh, 26.7 in 2019, average of over the past 5 years, 24.6, which is the variation is nothing. Then 2020, 24.8, average 24.6, which means just very, very close. 2022, 21, that's 25.1, average 24.6 is still within range, right? Then 2022, 24.1, average is 24.6. 2023, 24.4, average is 24.6. So this is how you kind of check what's the variation and the whole thing, right? So thank you everyone. I think this is where we're going to close the session. So remember, complete your own activity. Please don't send me blank Excel. I won't take as set. I was linear in the previous one. Now also the submission, I won't give you timeline, but don't expect me to be responding to your email a day before the session or even the day of the session. I still know some people submitted this morning. That's not a very good time management. I also have some other commitments, so you don't expect me to sit down on my laptop and be expecting your email, right? So if something like this is taking you 5 days, then it says a lot about you as well, just about your commitments. I mean, all right. So thank you, everyone. And here I will share the recording after the session, and please try to complete it as part of your learning process. You get to do it yourself. All right. Okay. So thank you, everyone. If you have one or two questions, I will just stay back for maybe 1 or 2 minutes to attend it, and we call it a session. One is asking, can one change levels at this point? All right. Thank you, everyone. And please make sure you enjoy the rest of the day.